Hey guys, some of the most frequently asked questions that I get about investing is how much of my portfolio should be in stocks, how much should be in bonds and real estate. Maybe you've heard of an emergency fund, but you're not sure how much of your portfolio should be in cash. Well, I wanted to make a video today to specifically address these points. We'll take a look at some suggested portfolios that I've come across over the years from some of the best minds in the investment world. I post a video every Tuesday, so be sure to hit the subscribe button and the notification bell so you get an alert whenever I upload a new video. So the main asset classes that people will generally look at in their portfolio will be stocks, bonds, real estate and cash. Now I know maybe you've got some bitcoins, and yes, there are other asset classes as well, like cryptocurrencies and art. But just to keep it simple, we'll focus on the most popular asset classes for this video, and maybe in some future videos I can look at some of the other asset classes as well. Okay, so let's look at the main asset classes, and once we're clear on what they are, how much we should be investing into each of them in our overall portfolio. So stocks are basically where you go out and you buy the shares of a company on the stock exchange. And by doing this, when you own those shares, you actually own a tiny portion of the overall company. And so stocks are often considered growth assets. And we see this because if we look at the past 90 years of US stock market performance, we see that the US stock market has generated 9.8% per year on average. But these are also considered more risky because the stock price can fluctuate quite a lot and can be quite volatile. You may remember just a few months ago, in around March, April 2020, we saw the US stock market drop by over 30% in less than a month. And so if you're investing in stocks, you may be willing to take that additional risk and volatility, but with the understanding that you'll be compensated with a higher return over the long term. Bonds are considered a safer bet. Here you can go out and buy these debt securities on the stock exchange and they'll pay you some interest. So let's say, for example, you go out and you buy $1,000 of Tesla bonds. Well, these bonds will pay you interest, and when that bond matures in the future, there will be a known maturity value at that point, which is guaranteed by the company. And because of this known future value and the fact that bond investors get preferential treatment if the company goes bust, it means that bonds are considered a safer investment, and as a result, you're also likely to see lower returns. For those of you that have been watching my videos on finance fitness, you'll know that I'm a big fan of investing in real estate, and it's a personal favorite of mine. And this can be all kinds of real estate investments, whether it's a single family home or an apartment or a condo or a townhouse, maybe farmland, or a real estate investment trust, also known as a REIT. And if you're interested to learn more about investing in real estate, I've done quite a few videos on the pros and cons with some real life examples, so be sure to check that out on the channel. Having some cash at hand can tide you over through a difficult financial period, or maybe enable you to take advantage of opportunities that appear in the market. Most people consider a 3 to 6 months worth of living expenses as a good buffer to have in cash. So some of you may be familiar with Ray Dalio. He's the founder of the biggest hedge fund in the world and somebody that I quote quite often on this channel. Ray generated some headlines earlier this year when he said that cash is trash. And I did a video on this to try and look at it in a bit more detail, so I've included a link down in the description for you. Okay, so we've looked at all of the main asset classes and what they mean, but now it's the most interesting part, the juicy part, which is how much should you be investing into each of those asset classes in your portfolio. There is no shortage of conflicting viewpoints when it comes to this. But here are some of the popular opinions from some of the best minds in the investment world. So there's this one theory that you take 100 and you subtract your age, and the answer you get is the proportion of your portfolio that you would put into stocks. And in some ways, this makes sense, because if you're younger, you'll take 100 minus your age and you get a bigger answer, which means you have a bigger proportion of your portfolio invested in stocks. And that means you can generate higher returns over a longer period of time and accelerate your wealth creation journey. And if you lose money, well, since you're young, you still have a lot of time to recover those losses that you may have incurred. I mean, let's say, for example, you're 20, right? So 100 minus your age will mean that 80% of your portfolio will be allocated to stocks and the remaining 20% will be in cash and bonds. And as you get older, well, you've built up this nest egg. Maybe you don't want to take on more risk and you prefer a more defensive strategy to try and protect the wealth that you've generated over the years. The parents of a good friend of mine retired in 2007, just before the global financial crisis. And they had a lot of their retirement saving invested in the stock market. And so when the stock market dropped by over 50% during the crisis, it wiped out a lot of their money and caused them a lot of stress, because all of a sudden they had less than half the money that they had planned on retiring on. So to many, this asset allocation of 100 minus your age makes a lot of sense. It's easy to use and has a lot of logic to it. But there are a few drawbacks to it. Number one is that it doesn't take into account your personal investment objectives. Maybe you're ambitious and you want to retire young at 30 or 35 or 40. In that case, it may not be appropriate for you to have so much exposure to stocks, and maybe a more conservative approach would be better. And number two is that it doesn't take into account your risk appetite. Even if you have two people with the same age, they may feel very differently about taking on investment risk. Maybe you're more aggressive and you're comfortable accepting a bit more risk. Well, in that case, a higher allocation to the risky assets would be appropriate for you. But maybe somebody else is really uncomfortable with the thought of incurring losses. And so in their case, a more conservative approach would be better. In the book Money Master the Game, Tony Robbins interviews 50 of the most influential people in the investment world. People like Ray Dalio, Jack Bogle, Warren Buffett, and Paul Tudor Jones. And many of them shared some of their portfolio suggestions. And one of them that really stands out is from Ray Dalio, who I mentioned earlier. His approach focuses primarily on diversification. The concept of not putting all of your eggs in one basket in case that basket drops. And this focus on diversification also comes through in his suggested portfolio, where he has a 30% allocation to stocks, 55% to bonds, 7.5% to commodities, and the last 7.5% to gold. And one of the reasons this portfolio really stands out is because the small allocation to stocks, only 30%, and rather a bigger focus on diversification with big allocations to bonds at 55% and gold at 7.5%, which are both considered safer investment options. David Swenson has been managing Yale University's investment portfolio of $23 billion for many years now, and very successfully. And so here is his suggested portfolio. He has a 20% allocation to US stocks, 20% to international stocks, and 10% to emerging market stocks. So all of those together make up a 50% allocation to stocks, which is probably in line with what a lot of people would expect to see. Then he also has 20% to REITs or real estate investment trusts and 30% to bonds and cash. It's quite interesting to see that he has a 20% allocation to REITs or real estate investment trusts. Now, I recently did a video on this, just sort of explaining what they are and how it works and the pros and cons of investing in them. So I've included a link in the description down below if you're interested. My personal preference has always been to invest in the physical real estate instead of REITs. But either way, this suggested portfolio has quite a large allocation to real estate. Okay, so I have two more suggested portfolios to share with you before we bring this all together and see how you could split your investment portfolio across these different asset classes. And if you're finding this video useful or interesting, make sure you hit the like button. Jack Bogle was the founder of Vanguard, which is the largest ETF or exchange traded fund provider in the world with total assets under management of over $6 trillion. He's also credited for coming up with the idea of ETFs, which has now become a very popular investment product. Jack has his personal portfolio split with a 60% allocation to stock ETFs and 40% to cash and bond ETFs. As you can see, Jack has all of his money invested in ETFs. And this could be a good option for you too, because it's a very hands-off investment and it's really cost effective because the annual fees are super low. Warren Buffett is probably a name that many of you guys have heard of before. He's an amazingly successful investor and has built up a massive empire in his company, Berkshire Hathaway. And Warren's suggested portfolio is to have 90% invested in low-cost equity index funds, which is really stock market investments, and 10% in cash and bonds. Buffett has always been a big fan of investing in low-cost equity index funds and ETFs. So we see a proposed portfolio from the Oracle of Omaha that's much more aggressive than some of the other portfolios we saw earlier. Okay, so how should you split your portfolio? And stick with me to the end because I'll show you how I split my portfolio as well. Well, you've now seen some suggested portfolios from some of the biggest names in the investment world. And you've probably also seen that there's quite a lot of different views. Some of them have real estate and some do not. Some of them have a small allocation to stocks, while others have almost everything in stocks. Some look more specifically at the US, while others look more from a global perspective. And as I was going through these suggested portfolios, maybe you felt yourself drawn to one or two of them. This is a good starting point because it shows you which resonates best with you. As you can imagine, the portfolio that's best for you may not be best for your friend or family member. It's really driven by your personal considerations, like your age, your investment objectives, your risk appetite, maybe taxes, or how long you want to be invested for. For me, I find this stuff super interesting and I nerd out a bit when it comes to investments. So I've taken certain parts of each of these suggested portfolios to build up a portfolio that makes the most sense to me. I've always been a bit more open to taking some risk for investments. And with my age and where I am in my life, I have a larger portion allocated to equities and physical real estate and a lower proportion in bonds and cash. So for me, real estate makes up around 40% of my portfolio. 35% is in stocks, which is mainly in ETFs but also some individual stocks, and the rest is in cash and bonds. The allocation that I have in my portfolio to real estate is probably a bit higher than most people would have, and this is just a personal preference because I really like investing in real estate. I did a two-part series of the pros of investing in real estate in the past, and I've included a link in the description down below for you. I just feel that the potential returns that you can generate are higher than other asset classes. A necessary disclaimer here, guys, I'm just sharing some ideas and suggested portfolios that I've come across over the years. But there isn't a one-size-fits-all portfolio that works for everybody. So it's best for you to speak to a financial advisor to make sure you build your portfolio in a way that makes sense for you. How have you been splitting your portfolio? And what are you planning on doing in the future? Tell me in the comment section down below. Also guys, I've included a link to this Money Master the Game book in the description. I know it's a big book and it takes quite a while to get through, but it's filled with a lot of useful content for investments. Many of these suggested portfolios come from here and they're covered in much more detail. And there's also many more suggested portfolios. Also, you can follow me on Instagram. Here is my handle. And guys, if you've enjoyed this video and found it useful, make sure you hit the like and subscribe buttons. I'll see you next week.